So, Karan, given what is happening in the market, um, the topic that I wanted to cover now, which would be probably of interest for many people out there,
Mhm.
is to talk about the science behind identifying a bottom of a market. Okay. Now, but before we get into any of the technicalities, I want you to give a sense of what does a market bottom, actually means. Like, what is the right way to even think about it?
See, thing is, we are sitting in India,
Mm.
okay, and in our generation, we have seen an upward trending market. Okay, there have been
Okay.
some setbacks
Mm-hmm.
like 2008 crash. Okay, then fragile five related, negative market movements, COVID crash. Even if you consider present correction,
Mm-hmm.
okay,
Mm-hmm.
there have been some setbacks, some deviation, but it's largely followed a long term upward going trending line, upward sloping trending line,
Correct.
right? It's
Right.
largely. So India is right now sitting at let's say around 3,500 to 4,000 GDP per capita in US dollar terms.
Mm-hmm.
Okay, and till we reach around let's say 12,000 levels,
Mm-hmm.
three times from here, it will continue to be like that. Okay,
Right.
so but there is a point at $12,000 level. There would a point would come where there are no new people who are coming out of poverty.
Mm.
Okay, the basic standard level living standard has been achieved. uh, Most of the people already have houses, most of the people already have cars, most of the children are already going to school.
Mm.
Okay,
Mm.
already healthcare spending has reached an optimal level. So overall consumption growth or economic growth or income growth, you can say,
Mm.
that would reduce, that would become stagnant. Okay, because
Okay.
incremental growth would be very less.
Very less. Okay.
Right
Okay.
now what we are doing, we are basically trying to fill the gap, consumption gap, with
Right.
other countries.
Mm.
So at 12,000 GDP per capita level, typically that disappears. Okay,
So
and
you're
that
saying that right now the per capita level that we are at,
hmm,
there is a huge potential even to fill in the essentials
essential,
for a large number of
large
people
number
in
of
the,
people.
yeah,
Yeah,
and that is why we are more or less on a longer term horizon. We are on an
upward sloping.
upward sloping
So
line.
like
Okay.
country in if you look at the countries like Brazil, Turkey,
Mm.
even Russia, they've
Mm.
remained there forever.
In
Okay,
the te-
that middle income trap.
the
You can
10 to
that 10 to
20,000.
20,000. That's middle income trap, kind of. Okay, some countries have used the export model
Mm.
to go towards in
Japan.
Japan.
Mm.
You can say Germany.
Mm.
Okay, some countries relied on technological progress like US.
US. Right.
Okay,
Mm.
to break out of that middle income trap.
Right.
Okay,
So you're saying that between 10 to 20 is when your local consumption story has more or less saturated,
saturated
and you need a new, genuinely new
trigger,
approach to actually push the
but
trend line
but
further.
there also upward trending line is quite difficult to achieve and
Mm-hmm.
sustain, and cycles are quite longer. You can say that
Right.
like Japan saw some 30-year bear market. Okay,
Mm.
starting in
Mm.
91. Nasdaq,
Mm.
that made a peak during just at the onset of dot-com bubble,
Mm.
and then it made a new peak 13 years later.
Mm.
Okay,
Mm.
so
Right.
cycles can be quite longer and stagnant, so their bottom doesn't make much sense. Okay,
Finding the bottom
finding the bottom doesn't make much of a sense because you can remain at those levels for quite long
for
duration, for
years to.
5-6 years as
Mm.
well. Okay, in India, because it's an upward sloping market, so
Right.
eventually bottoms revert to that long term average, and peaks also come down, correct, and come to that long term average.
Got it.
Okay, so
Got it.
it oscillates around it, and it's a mean reversion point, kind
Right.
of that. So here bottoms make sense because you know that in 2-3 years you're gonna join that, you're gonna mean revert to that long term trend. Okay, so here
Okay.
bottoms make sense.
Okay. Okay.
Yeah,
So in that context, are we near the bottom?
that's the answer everybody's searching for.
Yeah.
See, entire see, in country like India, where you have upward trending slope for
Mm.
Nifty 50
Mm.
index, you can say that 12 to 13% annualized returns for
Mm.
10 to 15-year holding period is quite normal. You can easily get that.
It's an
Okay,
average
it's an average
expected
thing. Okay,
return.
so entire fund management industry,
Mm.
including us,
Yeah.
okay,
Right.
is basically relies on identifying the peak and bottoms and make additional money from them.
Right.
Okay,
Right. Mm.
so if you talk about the bottom in
Mm.
India, we can say that we so first whiff of bottom was in November. Typically
Okay.
we believe that we are still in bull market. But in
Okay.
bull markets also, there are corrections and bear markets. Okay.
Even within bull
Within
market.
bull market. So if you consider 2003 to 2007 bull market, there were two bear markets. Okay.
That's I usually considered one of the best
Best period,
bull
yeah.
runs. Yeah.
There were two bear markets, and maximum loss, the maximum drawdown was around 30%, 32%.
In that
In that,
period.
we are nowhere there even today.
Okay.
Okay, and there were, apart from that, there were five independent correction. Correction mean 10% decline from all time high. There were independent corrections which are there.
Wow.
We have not seen that kind of volatility in this bull market yet. Okay,
Okay.
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 So we believe that we are still in bull market, but
Mm,
yes, we are going through a time correction
mm,
that is there. Okay, so we initially it was believed that time correction generally in bull market time corrections bottoms are made in 2 months. Okay, when
mhm.
you are in bull market and there is a correction of bear market, bottom are made in 2 months.
Right.
So we saw a bottom around November 20.
Mm.
Okay, November
24.
19, I would say. Okay,
Oh, November
November 19, 2024.
24.
We
Mm.
believe that the bottom has been made. Nifty was around 23, 200, 300 levels. Okay, and there was a recovery as well.
Mhm.
But but there was a gap, and I think the gap was market wide. Okay, thing is that Nifty corrected and it made the bottom. Uh, FIs were taking out money from large caps.
Large
If you
cap.
look at the data today, we know that FIs were taking money largely from large caps. Small cap and mid cap, they've actually increased the holding slightly.
Oh,
Okay,
okay. Okay.
okay.
So
So
most of this money flowing out of
flowing
FIs
out of
is
large
from large cap.
large caps, and then there's a historically
Mm,
we are in there's an anomaly that there is a disproportionately higher allocation
mm.
from in mutual fund SIPs to mid cap and large cap today. It's a
Okay.
break from historical precedents.
Okay.
Normally, it's a mid cap and large cap funds. They are taking much higher chunk of those
Right.
SIPs.
But now
Okay,
it is reversing.
we don't know yet. We have to wait for data.
Okay.
Okay, so but so that create a historical discrepancy
Okay.
where large cap corrected, but small cap and mid cap didn't correct. Okay,
Even though
enough.
in usually what tends to happen is if large
They
cap
correct.
corrects,
They
we
correct more.
correct even more.
So
Right.
usually the correction ends. Bottom is made when 1 year return of large mid cap and small cap
Mm-hmm.
become lower than compare vis-a-vis large cap. That's when the bottom is actually made. You can say
Okay.
this time it didn't happen. In November, alpha was still around 8% for mid cap and large small caps. Okay.
Okay.
So basically there was a gap and market came down again in Feb to cover that gap.
Pulled by mid cap and small cap.
This time it was mid cap and small cap. So in
Okay.
14 by 14 September 14 Feb we believe that correction is over. That technical gap is filled now.
Okay.
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 So now what we are doing for last 14 days in the market is more of a kind of a panic selling because some technical
Mm.
levels are broken. Okay, so people are under fear because
Right.
the this correction lasted about 5 months, and that's longer than whatever we've seen since 2021. Okay, so
Okay.
some new investors are getting restless and
So then, from what you're saying, you're suggesting that most of the correction that has actually happened in the market,
Mhm.
at least until early March 25,
Mm.
is largely driven by Indian factors,
It's
local
the Indian
factors.
factors because markets were quite frothy
Hmm.
at the end of September 2024. So if you look at the again, I'm returning to long-term trend line.
Hmm.
Nifty was trading at 24% premium,
Mm-hmm.
24 to 25% premium. To trend line. That's one standard deviation above historical mean.
Wow.
Okay,
Hmm.
so that's a classic cash call signal. Okay,
Okay. Okay.
that has worked historically, 100% accuracy. Okay,
Okay.
so that's a classic cash call signal. Okay, and that is indication the markets are frothy.
Hmm.
Okay. Second thing was that if you compare India with historical markets, now I will coming to FII.
Hmm.
Why FII started this carnage?
Right.
Okay, so it was also triggered by some technical indicators apart from Trump trade.
Mm-hmm.
Okay,
Mm-hmm.
so Indian markets, if you look at the alpha for Indian market, 1 year alpha for Indian market, that was at historical peak vis-a-vis China and US. Okay.
Right.
And it was in key reversal zone. Historically, whenever alpha has reached that level, it has reversed from there and it has gone to negative zone.
Okay.
Underperform, basically gone to outperformance to underperformance zone. So it was a classic signal that India is going to underperform for
Hmm.
FIIs.
Right.
Okay.
Right.
So there was a some worries around the frenzy in the market,
Mhm.
then there was these kind of technical signals that got
Right.
triggered. So that led to FII selling,
Pulling out money.
pulling out of Indian market and investing in either in their home market or in China.
Right.
Reallocation you see. Okay. Uh, uh, we can say that the post-election rally was built on expectations around EPS growth and economic growth.
Mm.
Okay,
Mm.
capex expenditure. Okay, we there were huge economic expectations from Modi's 3.0. In first 9 months, you can say 6 to 9 months.
Mm.
This quarter has not been that bad, but it's
Mhm.
been clubbed now
Right.
when things are going wrong.
Hmm.
Okay, so in last 9 months, the economic growth has uh, basically it's underwhelming.
Okay.
It's underwhelming to say the least. Okay,
Right.
the GDP growth number for last quarter was around 5.4 as
Yeah.
compared to expectation of 7%.
7%.
7%. Okay, uh, if you look at the EPS growth,
Mm.
Nifty 50 company EPS growth was literally zero. Mid cap was actually negative for first 6 months.
Wow.
Okay.
Mm. Mm.
Uh, so basically, EPS growth was zero. Economy was not going well. Urban consumption, there was a lot of commentary. If you look at the cement consumption data, auto consumption data, all was signaling a heavy distress in urban consumption.
Mhm. Mhm.
Okay,
Mhm.
so these all factors also played their part.
Right.
It's not just that the technical or Trump, we cannot blame on that.
Mm.
Economy was slowing down
Mhm.
and FIIs were reacting to it. Even domestic investors were reacting to it to some extent, you can say.
Got it.
Okay. But we can say that domestically, when you come to local things, we have put our house in order in last 1 or 2 months. There has
Mhm.
been a rate cut.
Mhm.
Okay. Inflation has come down. Basically, it gives the leg room
Mm.
to RBI to go for further rate cuts.
Right.
Okay. Inflation has
Right.
come down. Uh, uh, to boost the urban consumption, RBI has in the budget there have been
Some
some tax cuts.
provisions. Yeah.
Some tax cuts are there. Okay, so literally everybody would make somewhere around additional ten
Mm.
thousand a month. The
Right.
kind of scenario is there. Everybody would be taking home some 8 to 10,000 a month.
Right.
Okay,
Right.
additionally,
Which will definitely boost consumption.
which should boost
Right.
consumption. It is not negative to say
Right.
the least.
Right.
Okay,
Right.
to say the
Right.
least, it's not negative.
Mm.
Okay, RBI is also going for some liquidity measures.
Mm.
Okay, to boost the liquidity in the market. That should also help in credit growth. Okay,
Right.
there's some credit crunch was there, some stress was there. So credit, it will help create some liquidity for
Mm.
credit growth.
Mm.
Okay, and should also be a support for consumption. Okay, when it comes to EPS, last quarter was actually good. It was much better than expectations. If you
Right.
look at the mid cap space nearly delivered some 10% EPS growth
Mm.
after being flat for 2 quarters.
Mm.
Even Nifty 50 companies, if you see, growth was around 5.5%. Okay, for if you look at the TTM last trailing 12-month EPS from last quarter to this quarter is grown by around 5.5%. So we can expect a double digit growth, EPS growth. Next year, EPS growth is expected to be 18%.
Wow.
Okay.
Mm.
So in locally, we are actually, we have put our house in order in last 1 or 2 months,
So
I would say.
So, just to summarize here, you're saying that there is definitely these corrections were very much on the cards because of the local factors
Yeah.
itself, right? But now, in the last couple of months, we have started putting things in order, be it the RBI measures,
Mhm.
be it the tax provisions, be it even the EPS growth that has actually started to
Even
come
if you
about.
come to technicals,
Mm.
last 6 months have been exceptional in the sense that Indian market has lost around 15% on
Mm-hmm.
an average. You can
Mm-hmm.
say around 20% on the average of the market cap. All the other global markets have done well. They've added something.
Right.
China has added around, you can say 40%, 30-40%. Okay. Even if
Even
you
in Pakistan,
even
it has.
Pakistan, even if you look at the German markets, they've added
Yeah.
around 10-15%. Okay.
Right.
I don't know who is investing there and what they are investing.
Right.
German markets, uh, for now,
Mm.
uh, looking at the levels and at the end of the Feb end, 24-year returns are 0% now. They become 24%. 24-year returns become 0%. That's what I'm talking about bottom at the
Right.
beginning. Okay,
Right. Right.
so uh, in just 6 months, story has now reversed. Okay, India historically 1 year underperformance for Indian market is at all-time high underperformance this time. Okay, and it's in a very strong reversal zone.
Okay.
When
But this is where the joker in the pack comes, which is the US,
yeah.
led by Mr. Trump and his favorite Mr. Musk.
Hmm.
What is the story there? Like, because I know that the US valuations are pretty crazy.
Hmm.
So like all these FIIs taking the money out and putting back in are only pushing the valuations even higher.
Yeah.
Um, so, and given that mm, Musk and Trump seem to be promising a third of a cut in when it comes to government spending. So these are classic, scenarios for a deep recession to come in the
Hmm.
US, right? Like, and if that comes, I'm sure we are going to get impacted. So where does this factor into our situation right now?
See, thing is, there are triple threats we are talking about.
Mm.
First is Trump tariffs.
Right.
Okay, tariffs we are talking about where there would be some punitive tariffs that would be put on import from some selective countries or maybe world at large.
Yeah.
Okay, thing is, these valuations that you're
Mm.
looking at
Mm.
right now, Nasdaq is trading around 35x, last seen in 2000, just before dot-com
Dot
bubble.
com bubble. Yeah. Yeah.
Bubble. Okay. S&P is trading around 21, 27, 27x. In fact, if you see every single country in
Mm.
G20,
Mm.
right now their valuations are above their 10-year average. India is the only country that has valuation below 10-year average.
So
Okay.
we are definitely in a reversal.
We are
Yeah.
definitely in reversal zone,
Mm.
to say that. Now, coming to US, before I lose track of it.
Mm.
See, thing is, these valuations are built on premise of low interest rates.
Mm.
Okay. Already Fed has suspended the interest rates by 6 months. Okay. Yields have been increasing in recent past. Okay. Lot of money is flowing into US. That's indicated by strength in US dollar index. Okay.
Right.
We can say that lot of money is flowing into US. So where does this money is going?
Mm.
Where is the money?
Right.
Okay. Where are people investing? Bonds yields are still increasing for bonds.
Mm.
Okay. They have not gone down significantly. So money is not definitely not flowing into bonds. Okay.
Right.
Only equity valuations are going high.
So it is
Okay.
in the equity
It is
markets.
going in equity.
Mm.
Okay. And considering US bonds are looking at some fourth or fifth year of loss.
Mm.
Okay. Most of the US households are also piling money into equities. Okay.
Yeah.
So right now 50% of US household wealth is parked in equities.
That's crazy amount
This
of
came out.
money.
Its historical average is 24.
Right.
The only time it crossed 45 was in 2000.
Again during the dot com
Dot
bubble.
com bubble.
Mm.
Okay. So US is in prime zone. The market frenzy that we're talking about in India in September, it is in
Mm.
classic market frenzy zone.
Right.
Okay. With yields, Trump tariffs are going to push the yields even higher.
Mm-hmm.
And the biggest joker in the pack is dog. Nobody's talking about
Doge,
dog.
yeah. Doge,
So
yeah.
the dog people talking about in terms of local disturbances, job
Mm.
losses, and but people are not talking about the real impact.
Mm.
It can actually trigger recession. Okay, and I have a contrarian view.
Mm.
Most people are ruling out U.S. recession possibilities till
Mm-hmm.
last month, end of
Uh-huh.
last month. But I am of the contrarian view. They are saying 2 trillion.
Mm.
Okay, that's
Budget
30.
cut,
That's
yeah.
33% of the budget.
Mm.
Okay, let's say they deliver 500 billion.
Just 10% of it.
Just let's say 25% of it. Okay,
Okay.
let's say it's just they are shooting for the stars and they stuck with 500 billion. You're talking about 10% of government expenditure. Okay, so 10% government expenditure cut, and we are saying that there would not be any impact on consumption, retail sales, employment. Okay,
It's
you have
impractical to even think that.
impractical to even think that. So
Mm.
US is gonna see a recession.
Mm.
Okay, if they deliver on those cuts actually.
Right.
Okay,
Right.
with tariffs.
Yeah.
Trump is a deal maker, so might remove the tariff
Yeah.
again and everything. So US is gonna see a recession.
But that is going to impact us also, right?
Yes, there would be some 20-25% drawdown in US market.
Mm.
Valuations would come to normal level. Inflation would go down. Okay, interest rates would also go down.
Mm.
It's good for US. Their liabilities would also reduce. Okay.
Right.
For India, yes, interest rates would go down, global inflation would be down, and yes, there would be impact on equities. We are already undervalued.
Mm.
Okay, so there might be some 5 to 7% correction that would be still be there. Okay, you can
Okay.
see levels of 21,000. Okay, there is also possibility that under political pressure, Trump do not go. Trump basically decide not to go for that.
The
Okay,
cuts, you mean?
the cuts. Okay, They take a call. Okay, let's continue the regime
Mm.
as it is.
Right.
Okay, then valuations will go even higher. Okay, you are talking about valuations of 40, 45 for Nasdaq companies. Okay, for S&P you're talking about 35, 36. You will see S&P at some 8,000 levels. Okay, by year end. Then the damage would be around 60%. Okay, in both these scenarios, let's say recession take place,
Right.
so India would go down to 21,000. Okay, discount would become quite steep, some 15-20%. Interest rates would go down, inflation would go down. It would be very much like a COVID scenario, COVID 2020
Right.
scenario, with better fundamentals. Mind
Right.
it,
Right.
mind it with better fundamentals.
Mm.
Okay,
Mm.
so you might see first of all a valuation reversal of 20%. Then on top of EPS growth of 10%. I'm
Mm.
going conservative.
Right.
Okay. In term because there would be a disturbance due to US. 10%. So you can see some 30% reversal from those lows, 28,000 level by year end. Okay.
Mm.
So that's the scenario that can be there.
Mm.
If you remember, 6 months ago, at the just before the election results, we gave a call for 28,000 by year end.
Mm.
Okay, so it's basically moving in line with that.
So
Okay,
in case that this is if recession happens.
happens.
Okay.
If recession doesn't take place, let's say in US, it doesn't happen. Okay, then you can see, so valuations of countries typically move together. It
Mhm.
cannot be like that US is going to 40, 45, or 35, 40, and we are still stuck at 18,
Mm.
18x of PE. Okay,
Right.
so you will also see valuations of around 28x, 27, 28x in India. You will see
Mm.
inflation returning. You will see interest rates again rising. Yields might rise to 7.5%. Okay, but there would be a market frenzy. Cost of fund would go down significantly. Okay, so you can see levels of even 32,000, 33,000, 34,000, depending on where you are by year end. But
Okay.
let me tell you, in this case, there would be a massive US market crash in Feb March. Okay,
In the next following Fed.
next following Feb, and it would be more like 2008 crash, 50-60% crash you're
So
talking
in
about.
a way, you're saying that it is better if there is a recession now.
Yeah. But even if you are looking for market bottom, if you're looking for market bottom, this is a decent level to enter the market.
Right.
Okay, most of a big chunk of correction is already done. Economy is not going in recession.
Mm.
Okay, there is a cyclical slowdown. Okay, which is common in India in election years.
Right.
Okay, so that provided a decent opportunity right now. Okay, even if market goes down, they might be looking at drawdown of some 5 to 10%. Okay,
Okay.
which is very normal in equity markets.
Right. So if I finally were to give you the last word in terms of in the investor advice, right?
Mhm.
Given sitting in India right now, what does a normal lay investor in India do? Uh, Maybe in the next month, maybe in the next 2 months. What
Mhm.
is the ideal thing that you would advise?
See, I would ideally say that money should be spread. Let's say you have 10 lakh rupees.
Hmm.
Okay, put entire money in floating rate bonds for now. Okay, that's an
Okay.
arbitrage or duration risk. Okay,
Hmm.
so it's a decent option. And over the next 16 months, do a 50 lakh, STP.
Mm-hmm.
Okay, systematic
Yeah. Yeah.
transfer plan. You can take 50,000 rupees
Mm.
every month.
Mm.
Okay, and those 50,000 month you can allocate basically 60% into equities. Go for index funds. Don't take manager risk or go for
Mm.
diet equity. Go for index funds, large cap and mid cap. Don't take small cap risk at all.
Right.
Go for large cap and mid cap. 10% you can put in international equity. Take Nasdaq exposure if you want to
Right.
take. Okay, 10% you can take put in gold.
Right.
I say 15%.
Right.
15-20% you can put in gold. 15-20% you can put in international equity. 60-65% you can put in equity. Index funds.
Right.
Okay,
Right.
keep doing that. Okay, for the next 16 months. If a recession actually strike, let's
Mm.
say in April, move a bigger chunk. Instead of 5 lakh, move 2.5 lakh. Sorry, 50,000, move 2.5 lakh.
Okay.
Okay, and do the
Okay.
same.
Do the same.
Do the same.
Okay. Okay.
Okay. And by the end of it, you would be left with some 2 lakh rupees. So I'm talking about some 16 STPs.
Mm.
Okay. So by end of it, you will be left with some 2 lakh rupees in, floating rate bonds, and you can keep as it is.
Got it.
So that's how you can plan asset allocation.
Mm.
Okay. Don't run after small cap funds in search of dip.
Right.
Okay, that might.
Which in many ways, this is exactly the strategy that, like in our PMS scheme, the factor income.
Mhm.
This is the kind of asset allocation model that we follow when it comes to
No,
that
you
scheme,
can
right?
also basically for risk adjusted, high risk adjusted returns, you can also go for factor funds. Some slice. You can
Right.
allocate some 15% slice in that equity part to some factor funds.
Got it.
Okay,
Got it.
but you have to believe that you would be there in the market for next 5, 10 years, 10 to 15 years. You can say on
Got
simple
it.
side. Yeah.
Got it. Okay. So that's the reality when it comes to what we believe in terms of market bottoms and what does the future look like, both in India and the US and its impact. Do follow us for similar content and catch you next time. Thank you.
Thank you.